The housing market, not looking so good right now. Unfortunately, because of rising interest rate environment that we're in, the housing market honestly looks absolutely abysmal right now. And I figured, why not talk about ETFs that could potentially help us invest in an environment when the housing market has maybe some big issues, okay? Let me give you a little preface of what's going on so far. This tweet from Markets and Mayhem shows a good chart, so I want to go over this. So the housing boom is becoming a bust as existing single-family home sales plunge back to levels we haven't seen since the COVID crash. So take a look at new home sales for existing homes. So here we have COVID, and COVID just absolutely, of course, it pummeled existing home sales. Single family existing home sales. And then we had a giant jump back up as more stimulus was thrown into the economy and there was tons of money flying around and low interest rates, right? So these all kind of boiled up and allowed prices of homes to go up and demand for homes to go up as well because interest rates are so low. So then we have, a little bit of a demand goes down a bit, comes back up. And then when interest rates start rising as fast as they have recently, just absolutely have pummeled. And so obviously this is not good if you're investing in the real estate market, if let's say you have a lot of exposure to the housing market. So I just wanted to talk about maybe potential ETFs that can get us there. Here's kind of the issue that we might face in this idea of finding ETFs that will be shielded from the housing sector, let's say. So one of the problems here is that, for example, Ben Carlson has a good tweet here. The housing market makes up approximately 20% of GDP. So it seems like a bad idea to nuke such a large part of the economy. I hope the Fed knows what they are doing by allowing mortgage rates to get to over 7% in a hurry. And so here we have the chart of GDP that's inside the housing market. And so we have housing here, 11.9% is housing costs and utilities. We have furniture, repairs, maintenance, 3.2%. We have construction, 4.8%. So these are all huge components that go into GDP, right? And so one of the things we gotta kind of understand is that if GDP is highly affected by the housing market, right? Well, there might not be anywhere to really hide. So we're gonna have some different approaches to this. So one approach, the first one I'm gonna go over is, let's just say, let's not have any exposure to housing. So how do we do that with ETFs? So what we're gonna do is I'm gonna show you 6 different ETFs that have no exposure to the real estate sector. So that's kind of the first way we're approaching this. We're saying, okay, what if it's just the real estate sector that has its issues and we just don't have any exposure to real estate? Okay, how does that look? So the first 3 ETFs we're going over here, these have no exposure to real estate. And it's interesting, Triple Q, the NASDAQ 100, there's no real estate exposure inside Triple Q. That's interesting, and that's a potential for you to get around it. Now, being probably better would be Triple QM, which has a lower expense ratio. This expense ratio is 0.20%. So Triple QM has a lower expense ratio, and you get the same thing. So I just do Triple Q on here because everyone knows what it is. But Triple QM could be a great one. Triple Q also. SCHD. SCHD, everyone who watches my channel has an obsession with SCHD. I think it's a great ETF. I own some. I'm not probably as obsessed with it as some other people are, but that's fine, okay? Let's not get into that. SCHD is a great ETF. It's a great dividend ETF, right? So only a 0.06% expense ratio. There's nothing to dislike about this ETF. It's great, okay? So SCHD, you could throw that on the list. You got DIA, the Dow Jones Industrial Average ETF. Basically, it just tracks the Dow Jones, right? This one has a 0.16% expense ratio and also, a great ETF. If you want to have exposure to the Dow, then you can invest in this. So I'm going to show you here. These are the portfolios of these different ETFs. So if you take a look at the portfolios, Triple Q has 0% in real estate. SCHD, nothing in real estate. We got DIA, nothing in real estate. So there you go. When we're talking about potentially, let's say, finding ETFs that don't have exposure to this, here's 3 great examples. Now, I do want to show you that the general S&P 500, it doesn't have a lot of money invested inside real estate. Here I've added SPY into this thing. So SPY only has 2.8% in real estate. So obviously there's not a lot of exposure here. However, there are ETFs that have a lot of exposure to real estate. So I'm going to show you a different one, SPHD. So SPHD is an ETF that I've talked about on this channel before, and it's a decent dividend yielding ETF. But look, it's got 18.7% in real estate exposure. So if there's a giant real estate problem in the real estate sector, it might not do so well, right? So this is kind of what I'm saying. Find ETFs maybe that just don't have a lot of exposure to real estate. Maybe this could be a potential strategy or just an idea to maybe if something were to happen, you have that. So let's go over 3 more. So these are also popular ETFs that I've talked about on this channel before. So we have DGRO, the iShares Core Dividend Growth ETF. It's got a 0.08% expense ratio, so very low. We got VYM, the Vanguard Dividend High Dividend Yield Index Fund ETF, so 0.06%, low expense ratio. Also, CDC, higher expense ratio, 0.041% for the gross, and then the net is 0.036%. And also doesn't have any exposure to real estate. So let's take a look. I'll show you. So here we go. The portfolio weightings, just so you know, I'm not lying to you here. We got real estate. We got zeros for all of them. Let me show you the dividend yields because you might care about that. So for yields, I know a lot of your dividend investors and you do like to see the yields of these ETFs. So DGRO, we got SEC 30-day yield, 2.30%. We got VYM, 3.31%. We got CDC, 3.90%. Nice yielding ETFs. Now, I'm sure a lot of you probably want to see the other ones I mentioned, which I forgot to mention the yields on those. So let's take a look at QQQ, SCHD, and DIA's yields. So QQQ, we have the SEC 30-day yield at 0.81%, SCHD 3.79%, DIA 2.14%. So QQQ is the one that doesn't have a lot of yield on here because this is more kind of like tech sector heavy, not necessarily tech sector. You're going to get things like Google in there. Not in the tech sector necessarily, but kind of like tech-ish companies. So, we're going to get these companies in here that are going to be not yielding, high-yielding companies. And the other thing to think about this is, if you're going to go that route, that might have an issue with what's going on with interest rates in the future because of interest rates, and let's say we end up in like a recessionary environment, but interest rates are still high. These ETFs, the companies inside ETFs like QQQ aren't going to probably do as well in a high interest rate environment because the technological type of companies, low interest rates really help those companies out a lot more, as we've seen, than probably high interest rates do with SCHD's type of portfolio of companies, right? SCHD's doing fine. Well, it's doing better, a lot better than QQQ is in a higher interest rate environment, right? That's all I'm kind of saying. Okay, let's try to get to this next part. So another way to maybe shield us from potential real estate sector issues are to just like not be invested in equities at all. So let's get out of equities. Let's go into fixed income. However, of course, we know that fixed income has been a terrible, terrible place to invest lately. You're down almost as much as if you just invested in the general market, right? So maybe instead of investing in like a normal, not normal, but let's say an ETF kind of like BND, for example, which I'm showing you here. So BND on the right side, the Vanguard Total Bond Market Index Fund. So the thing with this one is, let's go and show you the mix of different fixed income securities that are inside this portfolio. So for BND, we can see over here the mix of the different bonds inside this portfolio, or fixed income instruments, right? So let's say we have government bonds, and so that's fine to me, right? Let's say you want to have 10-year treasuries, 5-year treasuries, 20-year treasuries, whatever you want to have in here. Okay, well, 45% is in that. And we have government related. Now, the other thing though is we have things like securitized fixed income securities. So we have agency mortgage-backed securities, right? And so this is where we kind of get into the idea, well, if there is maybe a housing market problem, are these going to have issues? I don't know. I have no idea, but I would just say I would rather stay away from having exposure to things like this in my bond portfolio if I was trying to invest in some, or have some exposure to things that may not be too affected by what might happen if there was a housing crash or something like that. So this has 21% inside agency mortgage-backed securities. So that I think could not necessarily, maybe that's not a great place to have money, in my opinion. So I would rather have a bond ETF that doesn't have exposure to something like that. So if we look instead at VGSH, which is the Vanguard Short-Term Treasury ETF, we're going to see over here, it's all government securities, right? So government, 99.42%, right? And then a little bit of cash equivalents. And then let's take a look at SCHO. This is the Schwab Short-Term Treasury ETF. It's very similar to VGSH. So same kind of deal here. We have 99.91% in government securities. So there's going to be things like treasuries. Now, the thing is, these are going to be shorter duration fixed income securities, right? So they're going to mature over shorter periods of time, which are good for interest rates. So if interest rates suddenly go up really high really quickly, they're not really long duration bonds. So they're going to kind of reset quicker. So this is actually going to be there's going to be less risk in this type of bond fund than in like a BND, which is an intermediate term bond fund. So I'll show you here the year-to-date ETF returns for these ETFs. So we have BND, negative 14.98%. So this thing has done, it's down quite a bit because of rising interest rates, and it's an intermediate term ETF, or intermediate term treasuries, bonds, fixed income securities. Then we have the SCHO, which we have in orange, and then we have VGSH, which we have in blue, and they're both only down about 4-ish% so far for the year. So you're going to get less risk with this type of bond fund. So the thing is, they're not going to have really huge returns, right? So if we go back and we look at the potential returns that we're getting for these, well, look, we got up 2.3%, up 2.36% for VGSH and SCHO over about a 5-year time period. Now, of course, BND is down 2.77%, but it did get up to highs of up 17-ish% at one point, and the highest these got to were about 7.91%. So they can have some capital appreciation, you would say. By the way, this is by reinvesting the interest that comes off of these, but that would just be something that you would have to decide. Do you want to just have some money that's kind of like hopefully going to be a little bit shielded from securitized, mortgage-backed securitized debt, right? That's a way to kind of maybe play this. I mean, another idea, I guess I would say. And then the final idea I have is to literally just bet against the real estate sector. So here we have the ProShares Short Real Estate ETF. This is REK. The thing with this one is it's an inverse equity ETF. So it's essentially betting against certain stocks. And there is a very inherent issue with this that I don't necessarily recommend to ever utilize these, especially over a long term, maybe potentially over just a very short-term period of time. And the reason is there's always like disclaimers about ETFs like this, inverse ETFs. And the reason is, and the thing I think a lot of people don't understand about inverse ETFs is this part here where it says the securities are designed for daily use only and are generally not intended to be held overnight. And so the reasoning behind this whole thing is like when you have an inverse ETF, you think, for example, if the basket of stocks here, let's say in the real estate sector, goes down 5%, well, you're actually going to go up 5%. It's the inverse of the return, right? And so that happens, but only on a daily basis. So if we're looking at just a day, well, yeah, it goes down 5, you go up 5, great. But it resets overnight, right? And so when it opens the next day, it's not the same thing. So if you look over a long-term period of time, like for example, if over a whole year period, it goes down 5%, you're not necessarily going to be up 5%. And that's the issue with inverse ETFs. But just to know that this is, I guess, a potential possibility for some people who are really into utilizing this, or maybe kind of more traders oriented in trading and things like that. But just something I figured I'd throw out here. It does have a net expense ratio of 0.95%. So again, very big disclaimer on an ETF like this. The first time I've actually mentioned an inverse ETF in this channel. But, I figured I'd throw everything at you for this one today. So hope you liked the video. Disclaimer here. Hit that like button, subscribe. See you next time.